Good morning, everyone, and thank you all for joining. It is my rare privilege and honor to welcome to the CIF virtual platform a man of great distinction, Mr. Benjamin Tal, Managing Director and Deputy Chief Economist, CIBC World Markets Inc. As we know, the pandemic has already taken several millions lives all over the world, leaving families and loved ones grieving at their loss. This is truly a planet-sized tragedy. Like in the case of earlier such epidemics, the COVID-19 pandemic also brought normal life to a halt across the world, impacting economies of all countries, rich or poor. We in Canada are living through the consequences of, in terms of the lost jobs, lost revenues, and looking at long and difficult recovery. When will life come back to normal is a question that everyone is asking. The lockdowns aimed at stopping the spread of virus have been particularly hard on certain sections of the populations, including immigrants employed in the small and medium-sized businesses. With the vaccines rollout picking up speed, a turnaround is expected. While there is reason to be optimistic, the negative impact on the economy and our lives will be with us for a while. How much longer? Will there be a V-shaped recovery, or will it be a slow crawl to pre-pandemic levels? Will emerging markets like India, where Canada has made some big bets, continue to perform? Well, that's why we have today an expert like Mr. Tal to put those questions to the test. Mr. Tal is one of the most respected commentators on the state of the economy, much sought after by the media and other public platforms. Today, he will review for us the current economic situation, the recovery, and implication for the financial markets. Thank you, Mr. Tal, for taking time out to join this morning and throw some light on these crucial and difficult questions. Once again, a very warm welcome, and we look forward to your presentation. Over to you, Mr. Tal.
Thank you very much. It's a pleasure. I'm going to share a screen now, and I hope you can see it. Do you see?
Absolutely.
A big page, that's the presentation. I hope you can see it.
Yes, absolutely.
So, okay, I can start. And of course, there is so much to talk about and never enough time. I would be relatively brief and see what makes sense and what doesn't, because let's face it, what we are trying to do now is to normalize the abnormal and to see what makes sense and what doesn't. And I will go very quickly to the first chart, because this is the three questions that I'm trying to answer during this presentation, with some implications for policy and, of course, financial markets, real estate, and others. The first question is, how bad is the winter? We know it's bad. We know that there is a second wave, and now we are starting to talk about a third wave. How bad is it? We'll discuss. The second one, how strong will the second half of the year be? I think it will be very strong. In fact, stronger than what the Bank of Canada is telling us. We'll discuss why. And the most important question is any scarring, namely any long-term damage due to COVID-19. Another way of asking that question is to what extent COVID-19 is an event or a condition. We'll discuss. But first of all, we have to discuss the virus. I know that all of you are tired of hearing about this virus, but unfortunately, the virus is not tired of infecting us. So we have to understand where we are. And this is the story, just an example. What's happening here? In January of this year, the Canadian economy lost 200,000 jobs. The American economy gained 50,000 jobs. Why? Because for a given level of infection, the US economy, since the beginning, was much more open than the Canadian or any European country. So the positive spin on this, as far as the US is concerned, is that economic growth was better. The negative spin, of course, is that the infection rate was much higher. So if you wish, the conflict that is defining this crisis, the conflict between lives and livelihood, is in full display here in the case of the US. And of course, when you talk about the virus, the second or the third wave, you must discuss the vaccine. And we all read the newspapers. I will not get into it. Canada, unfortunately, is behind. We are behind not due to logistic reasons, but due to supply factors. We are starting to close the gap, but over the next 6 months, we will be behind the curve relative to many European countries and clearly relative to the US. So in the short term, it's a bit of a struggle, and Canada will lag behind economically due to the very slow pace of vaccination. So if you look at overall numbers, they are not great, but they are better than expected. In the first half of the year, we are going to see GDP growth of about 2, 3, 4%. The spring will be a transition period, but then the second half will come. The summer will come, and I expect the summer to see 5, 6, maybe 7% GDP growth. And the question is why? And let's explore. The first reason is the nature of this recession. The damage due to the recession is very, very deep, but also very narrow. What I mean by that is that the number of industries that are impacted is relatively small compared to any other recession. So if you are impacted, if you are in aviation, hospitality, entertainment, you feel the pain very significantly. But the number of industries that are impacted is relatively small. 2/3 of the economy now, full swing, V-shaped recovery. Again, this is very abnormal, asymmetrical recession, which means that when we get to the other side of this crisis, it will not take too many industries to recover before we see the light. And that's actually going to be a much more speedy recovery. That's number one. Number two is the fact that all the damage is happening in the service sector. Usually, all recessions start with goods and then go to services. This one is all about services. In fact, the goods segment of the market is actually doing better than expected, better than it was before the crisis. Why? Because you press a button and you get your exercise bike. But when it comes to services, that's not the case. That's the bad news. The good news is that a service-oriented business is much more flexible than a manufacturing-oriented business. Put differently, it is much easier to start a new restaurant than to establish a new manufacturing facility. So the speed of the recovery, when we get to the other side of this madness, will be much faster because all of the damage is in the more flexible service industry. So it's going to be more speedy. So deep but narrow, and a speedy, more flexible service sector mean that the recovery will be faster. And then you have the third factor, and this factor is cash, income. This is the first recession in history that personal income actually went up. Listen to this. For every $1 decline in wages during the crisis, the Canadian government injected no less than $7 into the economy. I will say it again. $1 decline in wages, $7 increase in Canadian government money getting into the economy. No surprise then that actually income is rising during this crisis. More than that, the abnormality of this crisis is in full display in the case of the labor market, as you can see from this chart. All the jobs, not some, all the jobs lost during this recession were lost in high-paying occupations. In fact, high-paying jobs, their number went up by 350,000 positions. We have never seen anything like that in a recession. This is the most asymmetrical recession in Canadian history, with major implications that explain so many developments during this crisis. One of them is the fact that all the decline in spending is happening among mid to high income individuals. And if you think about it for a second, it makes sense. Because low income Canadians, they spend most of their money or government money on necessities like food and shelter. So the people who don't spend are people who used to spend a lot on luxuries and they simply cannot do it. So they have the money, they have their job, their income is actually rising, but they cannot spend. So all of them are basically passive savers. They simply save, even they don't want to. Their checking account is getting bigger and bigger. All of a sudden, you see it on excess cash, basically extra cash of roughly $90 to $100 billion. This is checking and savings account sitting there looking for direction. There is so much pent-up demand. Those people would like to spend that money. Most of those people are dying to go to a restaurant, but they are not willing to die doing so. So they are waiting. But they are waiting until you have a green light. And the minute you have the green light, you're going to spend this money. This is pent-up demand. I had a meeting with our finance minister, and she asked me, what should we do to encourage those people to spend that money? And I said, you know what? Provide the vaccine and get out of the way. They don't need any motivation. They are motivated enough. What we need is just the green light. And the good news here is that this money will be spent where? In the service sector, exactly where you need the jobs. So you will have a situation in which every dollar that is spent is actually going to be very powerful because it will go exactly where it's needed. And that's the power of this pent-up demand. So that's exactly what we need. So overall, what you see here is very positive trajectory for the next year or so, with pent-up demand leading to a significant acceleration in the second half of the year into early 2022. That's the good news. Of course, everything comes with a cost. There is no free lunch. And one of the reasons why the economy is doing okay is government money. We know the story. The debt to GDP ratio is up from 30% to 50%. The budget deficit is approaching $450 billion. The debt level is north of $1.2 trillion. We know the story. And the question, of course, is who is going to pay for this debt? The short answer is, of course, nobody. Because at least in the short term, this money will be refinanced with low interest rates. And therefore, despite the fact that the level of debt is rising, interest payments on that debt are actually going down by $4 billion a year. That's because of low interest rates. At one point, however, we will have to deal with those budget deficits. So let's discuss it for a second. I believe that we are in the midst of a permanent increase in government spending. What I mean by that is that you will see the government spending even after the crisis more than before. Let's use some numbers to illustrate. Before the crisis, the level of spending as a share of GDP was roughly 15%. Now it's 35%. Crazy. Of course, it's unsustainable. It will go down. But when it goes down, maybe it will stabilize at 17, 18%. Why? Because without noticing, we are now putting together the plumbing, the infrastructure for tomorrow's social assistance program. We are talking about a universal daycare system. That's a great idea, but it will cost money. We are talking about some elements of basic income. That will cost money. We are talking about making the modified EI system more permanent. That will cost money. So I will not be surprised if 2 years from now, you will see the government looking at higher taxes to subsidize and finance some of this increase in spending. Already in the latest fiscal update, the government raised taxes on big tech, on stock options, and I will not be surprised if a year or 2 years from now, when we are removed from this crisis, they will raise the inclusion rate on capital gain taxes. They might take carbon money into general purposes for revenue. And if they are totally desperate, they will go after the HST. 1% increase in the HST is giving you $7 billion like that. So I suggest that we should expect some increase in taxation. It's already happening in places like the UK, where they announced that in 2023 they're going to raise the corporate tax rate by a few percentage points. That's the direction we are coming, and we know that Biden has a $3.1 trillion tax plan that is coming after the crisis is over. So I expect that, yes, now the spending is happening, it will continue. Eventually, there will be some increase in taxation. In Canada, I hope that it will be just capital gain and maybe some other things, but not income taxes where they are extremely high. So that's more or less where we are when it comes to government debt. But there is another issue. The government is spending money, and the Bank of Canada is printing money in order to finance that spending. So what are the implications? Now, there is a word in the English language that if you are under the age of 30, you probably never heard of. This word is inflation. In fact, I checked in the dictionary, and it still exists in the English language, inflation. Of course, it has been missing in action for so many years, and the question is to what extent we should start losing sleep over inflation. Let's discuss, because I believe that inflation fears are the number one factor that actually impact the psyche of the bond market and is behind the increase in long-term interest rates. Look at money supply. Money supply is rising at a rate we haven't seen before. Now, this is something that in Economics 101 they tell you can lead not only to inflation, but to hyperinflation. Now, the reason why inflation is not rising dramatically so far is because of the fact that in order to see inflation rising, you need to see not only money supply rising, you need to see also the velocity of money rising, the rate at which money is exchanging hands. And this rate is still in the basement because people are sitting on that cash. They are not spending it. But the minute they start spending it, that velocity will start rising. And therefore, it is essential that the Fed and the Bank of Canada and the ECB in Europe will start withdrawing from the market when the private sector is ready to start spending. And that's more or less where we are. And there is a tug of war between the market that is seeing inflation and the Bank of Canada and the Fed that are telling you this is not a time to worry about inflation. Yes, we are starting to see some acceleration in inflation. And clearly that will continue. I'm telling you that in the second half of the year, the economy will be expanding by 6-7%. A lot of this will go to the service sector. Prices in the service sector will start going up because we will be lining up to get our haircuts, to have a nice meal in a restaurant. Prices will rise. And the Bank of Canada and the Fed are telling you one thing. They are telling you that they are not losing sleep over that. Yes, inflation will be rising, but they see it as a short-lived trajectory. Basically, it will be there for a few months, and then it will go back to normal. And therefore, there is no reason to start raising interest rates prematurely for something that is going to be temporary. That's the notion of waiting for inflation and not worrying about it because it's not going to get into inflation expectations. It's not going to last long enough. That's the tug of war between the 10-year rate, the bond market, and the Bank of Canada. And of course, the Bank of Canada is now toying with the idea of the timing of the first increase. So far, they're telling us that they are not going to touch interest rates until 2023. The market is expecting the Bank of Canada to move by the spring of 2022. And there is another factor here. The market is expecting the Bank of Canada to move a full year before the Fed. I'm not sure what the market is smoking, but it's not going to happen. Canada is lagging behind the US. Economically speaking, the damage during COVID was more significant. Second, our vaccination trajectory is slower. And then we have the currency issue. The currency is at about 79, 80 cents. We have no business being at this level. It's way too high. And if the Bank of Canada moves before the Fed, it will go higher. That's the opposite of what the Bank of Canada would like to see. So I suggest that the Fed will move in mid to late 2022, and the Bank of Canada will wait for the Fed and maybe will go a bit after, not before. So I think that the market is mispricing the first move by the Bank of Canada. But when we start moving, I believe that we will normalize, but the new normal would be still lower than the previous normal, suggesting that interest rates will not be rising very, very quickly in a very sharp way. Why? Because the effectiveness of monetary policy. Monetary policy, interest rates, when they start rising from a very, very low base, they are very effective. I estimate that 1% increase now is equivalent to 2% increase 5-7 years ago, because there is so much debt. And the minute you start raising interest rates, even if you raise the 5-year rate by 100 basis points, it's almost like doubling your mortgage payments. That's significant. So the effectiveness of monetary policy in this environment is very, very significant, something that we have to take into account. So that's the story regarding monetary policy. But of course, you cannot talk about interest rates without talking about the real estate market. The housing market has been on fire. We all know the story. This has been by far the most housing market friendly recession ever. Every other recession saw the housing market going down. This one, a V-shaped recovery, more than a V-shaped recovery, with prices rising by 15-20%. You all know the story. So the question is why? And of course, the narrative is, well, interest rates are very, very low. It is true that interest rates are very, very low. But remember, if you look at 2008, when activity went down, interest rates were higher than they are now. But back then, they did not have B20. They did not have stress test. Today, in order to qualify for a mortgage, you have to qualify at 4.79%. So from a qualification perspective, interest rates today are actually higher than interest rates in 2008. Back then, the market was down, today it's not. So why? The answer is one of the charts that I showed you earlier in the presentation, the abnormality, the asymmetrical recession when it comes to the labor market. Remember, all the jobs lost were low-paying jobs. So that has major implications for the real estate market for two reasons. Most of the people that lost their jobs during this crisis were low income, therefore renters. They are not home buyers. And that's one of the reasons why the rental market is down. However, also, it means that a very large segment of the population was untouched financially by this crisis. In fact, they are better off because their income is up, their job is there, and interest rates are in the basement. That's the opportunity they were looking for. And that's really the secret behind the success of the housing market, because you have interest rates very low and more people are able to take advantage of it because of the abnormality, asymmetrical nature of this recession when it comes to the output from the labor market. And then you have this story. People are fleeing Toronto or Vancouver, large cities. Why? Because you can work from home. So you don't have to commute. So all of a sudden, distance means that you can basically go and drive 2 hours away from Toronto, buy a house, get a discount of 40, 50% on that house, and work from home. A win-win situation. And you can see that home price inflation is positively correlated with distance from the city. That's what we have seen now. This trend was there before because Toronto was unaffordable before the crisis, but it was accelerated during this crisis for a good reason. The question is how sustainable it is. I believe it will continue, but the speed of this trend will slow down for two reasons. One is that when the fog clears, people will be back at work. Many people will be back at the office. Companies are telling us that they would like to see their employers coming back. Maybe not 100%, maybe it will be 2, 3, 4 days a week, maybe it will be flexible, but the office space will remain the center for most of us, which means that if you bought a house in Barrie, assuming that you will be working from home 100%, that's an issue. Maybe you will be forced to rent or buy a condo in the city to be close to your work. That's one thing. The other is that maybe your current employer is okay with you working from home. But what about your next employer? That can impact the mobility of labor, something that we have to think about. So the bottom line I'm saying is that maybe the people fleeing from the city, that trend will slow down, especially given the fact that prices outside the city went up so rapidly, you reach a resistance level. And then we see some people coming back to the city, which I believe will be more bullish, especially on the condo space. And if we have time, maybe we can discuss it during the Q&A period. And the last point that I would like to make is basically the question, to what extent we are seeing COVID-19 as an event or a condition, namely scarring. This is an example of scarring. This is basically the 2008 situation. Namely, you go down, you have a recession, and if you follow this red line, you can see that the economy was growing more slowly than it did before. That's long-term damage. Something structural happened in the structure of the economy, in the ability of the economy to grow, and we call it a condition or scarring. And the question is, to what extent COVID-19 is a condition? And I believe that's not the case. I believe that COVID-19 is an event. We haven't lost production capacity. We haven't lost the ability to consume. We haven't lost the willingness to consume. And the risk-taking culture is still there. What we need is simply a green light. That's very different than the 2008 when we saw a significant change in the nature of the economy. This is not to say that everything will be back to normal. Obviously, e-commerce is taking over from retail, and that will continue to be the case, although not at this elevated level. Obviously, there are some changes to globalization and some element of deglobalization. There are some changes, but overall, this is an event. This is not a condition. And 2022, 2023 will be basically a continuation of 2019. So the point that I'm making is that yes, the global economy is being transformed, but when the fog clears, everything will look very, very familiar. And just to illustrate what I'm talking about, those are 3 pictures that were taken in 1919, only 1 year removed from the 1918 Spanish flu, New York, London, Toronto, like nothing happened. I hope that will be our lives a year or 2 years from now. I will stop here and see if we have time for a discussion.
Thank you so very much, Mr. Tal, for very insightful presentation, and shortly and sweetly covering it almost all aspect of the facets of economy. So we have few questions. We're going to start some interactive discussion now. The first one is one of our attendee. His question is that aviation industry, hotel and restaurant are part of the major service industry, and people will be very concerned till virus is fully removed from the scene. Also, many corporates realize that working from home improves their bottom line. Hence, aviation and hotel industry may suffer. And how do you react to it, as you alluded to that service industry will improve significantly? Any kind of thoughts on that?
Yes, so clearly, when it comes to hospitality, that will be one of the last sectors to recover, unfortunately, including also, that will include aviation. So aviation and hospitality will continue to suffer way into the second half of 2021. They will continue with this L-shaped recovery, although it will be better than it is now. It will not be full capacity by any stretch of the imagination. I don't see hospitality going back to normal until basically the second half of 2022, when people are very comfortable traveling and taking vacations and spending. So to me, unfortunately, those are the late bloomers, if you wish. But when they start moving, you will see huge pent-up demand going into this kind of services. But unfortunately, that will be one of the last to recover, absolutely.
Thank you. And the next question is that how do you think that developing countries like India and China can help developed economy for a big revival?
Yes, I think that that's a very important aspect, but I do believe that we are seeing the beginning of deglobalization in a different way. Namely, deglobalization started with Trump, if you wish. And we have seen the emergence of two trading blocs, China and its friends, and the US and its friends. And this is basically a semi-Cold War between China and the US. And if there is a Cold War, you have to choose a side. Canada, we know where we are, which means that our reliance on the US actually will rise. But it also means that you will see some activity and trade coming back home, especially in the US. I estimate that about 20% of what the US is now buying from China would come back to the US, especially in high-tech, medical equipment. We have a situation in which 90% of antibiotics in the US is coming from China. That will change. So you will see more activity coming home. Biden will do it differently than Trump. He will do it vis-a-vis coalition. Basically, it will be Canada, Europe, maybe India, but it will be a coalition putting some pressure on China when it comes to fair trade activity. That's the way I see it.
Thank you. And just a follow-up question. How do you view India versus Canada relationship in terms of the potential, what we are today and the future?
Yes, I think that this relationship is solid and extremely important. India has two things that Canada needs: knowledge, high tech, and young population. And this is something that we in Canada clearly need. So I think that India is becoming a major superpower over time with deregulation in the economy, as you all know very well. So Canada should capitalize on the growing force coming from India and the ability of India to supplement what Canada doesn't have. So I'm very bullish on those relationships.
Thank you. And my next question, how do you see the pricing for the housing little out of GTA area, remote area? Any those are going to
yes, as I suggested in my remarks, I believe that this trend will continue, but at a slower rate. I believe that we are getting closer and closer to some resistance level in which prices in those remote areas have risen so quickly, so fast. So at one point, people said this is a bit too much. We've seen it, by the way, in Vancouver, when in 2017, people realized that prices in Vancouver did not rise as much as other areas, and the gap really shrunk a lot, and they reached this resistance level. I think we are getting close to this resistance level, And that's something that we have to take into account. So it will continue, but at a slower rate.
Mr. Tal, a lot of participants have this question about stock markets. I mean, we see the way COVID is affecting everybody, but stock market is only going up and up. So a lot of people have concerns. What is happening with stock market? Where do you see why it is happening, and what is the future of stocks?
Yes, so first of all, people say, how is it possible that the economy is down and the stock market went up? And the answer is that in many ways, the stock market is not the economy. As I suggested, this has been a very uneven recession. 2/3 of the economy were in a full swing V-shaped recovery. 1/3 stuck in L-shaped recovery. The stock market in Canada, in the US, is tilted towards the winners of this crisis. High tech, technology, this kind of stocks. So therefore, you cannot talk about the economy as a whole. You have to talk about what the stock market is representing within the economy, and it's tilted towards the winners. That's one factor. The other is interest rates. We have never seen something like that. Interest rates going down so rapidly, so quickly, long-term interest rates and short-term interest rates. And interest rates is the best friend of the stock market because it improves your valuations down the road. So those are the two factors that led to this huge increase in the stock market. Now, we had all kinds of mini bubbles there. We have Bitcoins, which is very interesting. I'm very interested in the technology. I'm really not interested in the coin itself because I think it's speculative. I think it's a bubble, but the technology is something that will change the way we do business over time. So we have to distinguish between the technology and the coin. And also there is the retail investor phenomena that we're seeing. The good news is that so far, the stock market as a whole was an observer of that, not participant of that. So this is kind of a semi-bubble that is not part of the big story. Now, with interest rates starting to rise, you can see that the stock market is getting a bit nervous. And therefore, although interest rates are still relatively low, the stock market is still attractive in terms of investment, but you have to start looking at sectors that will be recovering, namely the laggers will be the leaders. If you assume for a second that you are going to see a significant improvement in restaurants, maybe that's the direction you want to go. If aviation eventually will take off, valuations are very, very low. Even some REITs can do okay in the rental market, stuff like that. So basically the laggers can become leaders given the trajectory of the economy.
Thank you very much. Cryptocurrency was actually another question which we wanted to raise because we've got a lot of people who've actually sent us queries and questions related to cryptocurrency, you know, whether it's a good investment vis-a-vis compared to stock markets, because a lot of people, like, they have interest, but unlike stock, they don't have that much information or foundation of crypto.
Yeah, I would be very careful with that. Listen, most people really don't fully understand how it works. There is no value against it. It's not backed by anything. It's pure speculation. It's not something to replace the American dollar, not yet. Maybe it's the beginning of the demise of the American dollar as a reserve currency. Maybe from a long-term perspective, probably not in our lifetime. But it's not, the valuation of crypto is basically based on nothing. It's based on almost a bubble-like situation. I really am not interested in that. I'm interested in the technology. I believe that crypto will become a very important part of the banking system. Banks will join forces with crypto, not fight it. But in order for banks to put crypto on their balance sheet, it has to be stable. You cannot have assets that change their value by 40% on a daily basis. Like, this volatility does not make sense. And therefore, what I suggest will happen over the next few years is major regulations of cryptocurrencies to allow them to become part of the financial system. The way they are now, it cannot be.
Thank you.
I have another question, Mr. Tal, that from the most of the Western economies right now, they are implementing made in own country, and vice versa, all the globalization which is taking place. What is the view of its effect on the Canadian economy down the road? As we all are seeing, made in locally is getting promoted everywhere.
Yes, I think that we have to be careful here. I will not, there is an element of self-preservation during this crisis. So people were making sure that their economies are fine. People were making sure that they vaccinate their population first before they export their vaccine. So this is self-preservation that we have seen during this crisis. In fact, early in the crisis, we haven't seen even coordination between central banks and governments, usually what you see in a recession otherwise. So clearly that was very different. We see some tendencies to, self-reliance, but that will be in some very specific areas for medical, for example, for high-tech, safety, security, but it's not going to be for the general market as a whole. So therefore, I suggest that about 15-20% of what the US is importing from China will come back home one way or another. I think that our reliance on the US will grow because Canada will be seen as an exception to the to buy American theme by Biden. So that's the way I see the situation.
Excellent. And what's your view on the retail market? As you see now, press of a button, you get everything delivered at home. So how do you see the retail sector doing?
Yes, we know that e-commerce gained 10 years of market share in 6 months. So it went up crazy. And then it lost some market share, but it's much more elevated than it was before. Clearly, when we go back to normal, e-commerce will go down a little bit from those levels, but it will be higher than it was before, and the trend will continue higher. We have now, due to COVID, all population that were not familiar with e-commerce, especially older people, that are more comfortable doing that. So even people in the 50s, 60s, 70s are doing it. Before, they were not comfortable doing that. That's something that will enhance the ability of e-commerce, and it will be with us. That's one of the long-term impact and sustainable impact of e-commerce. Having said that, I think that offline shopping will be exotic. The experience of shopping will be exotic. And therefore, the dividing line will be quality. I'm very bullish on high quality shopping malls, for example. I think people will be lining up because the experience of shopping will be something fascinating. Low quality shopping malls or stores will not give you the same experience, and therefore you will have no problem replacing them with e-commerce. So it's really a quality aspect. That's the way I see it.
Thank you. And Ritesh, over to you. Some more questions?
No, I think we've covered most of it.
So I have then on your view on immigration. Like we been hearing that the government is expected to get almost 1.2, 1.3 million people in the next 3 years. What's your view on immigration, its impact on the economy and overall?
Yeah, I think that's exactly what we're going to see. The quota went up to about 410K a year to compensate for the lack of immigration that we have seen last year. I believe that this year we'll get about 350, and then the year after we'll get 4 something. So we will be able to close the gap relatively soon. We will have to compete with the Americans on high quality immigration because under Trump, nobody was going to the US. Now Biden is opening the gates. So we will have to make sure that we attract high quality new immigrants. I think it's doable. I think it's very important to do. And I think we can do it. And I think that's very, very useful in terms of economic activity and demand in the economy. And I believe that will be another factor contributing to overall growth in the economy.
Excellent.
Mr. Tell, one more thing, like what do you think Canada should or economy should do to actually spread out economic activity and manufacturing to various parts of Canada? At the moment, looks like all the immigrants coming from all over the world, they are stuck either in Vancouver or Toronto, and some of them spill to Alberta and Montreal and whatnot, but 80% of them are in Ontario or BC. Don't you think that economy or Canada should do something that it's more spread out? The economic development is more spread out.
Yes, that's a major issue that has been with us for a long period of time. The large majority of new immigrants coming to the big cities, and that's one of the reasons why housing prices are rising so quickly. At the same time, you cannot tell people where to go. You know, it's a democratic system. You have to create the conditions in places like Alberta, Winnipeg, and other cities and provinces that will attract people. I think that telling people, listen, go there and you have to go there, that you cannot do. But if you provide some incentives, basically say, if you go there, we can help with housing. If you go there, we can help with something. And then create some job opportunities, that can do the trick, but it's very difficult to do.
No, that's what we meant, because, you have great relationship with, everybody at federal level as well. So probably that is the message you should convey to policy makers and leaders in this country, that we need to spread the opportunities. I mean, of course, I mean, unless and until opportunities are there, nobody would want to go. People are moving from their native lands to Canada in search of better economic opportunities. So if we can spread out opportunities, I'm sure, if they can come all the way from India or China, they don't mind moving provinces if there are opportunities.
Absolutely. I totally agree with you. Totally agree with you on this one.
Thank you. Thank you very much.
And you will see, spread out of the population. I think some of the issue, which is real estate skyrocketing prices, I think we can very well address through that if Absolutely. Our population is, scattered that way.
Absolutely.
We have a few participants who raised a hand, and let me see if we can ask them to question directly. Chirag, are you there? Mr. Chirag Shah, you raised a hand to ask a question. Okay, anyway. One another question, Mr. Tal, one of our member is asking that we all are dying to go back to the movie theaters. And do you think that will happen after post-COVID theaters gonna be in full demand? People would like to.
I suggest yes. It's going back to the experience as opposed to watching your movies at home on Netflix. I think that people will like the experience. People will like to be with other people. But for this, you need to be totally safe and totally ready and confident that you're safe. So that will take a while. That will not be July or August or September. That will be a 2022 story.
2022.
And I think Mr. Chirag has joined us to ask his question.
Sure.
Chirag, go ahead, please. Chirag, can you hear us?
Okay, let's go to the next level. Some of experience we are getting is that the construction cost is going way high, particularly right now. You name it in different trade sector or sub-trade level. What is your view on that? Because that will curtail construction activity dramatically. Some of the items we have seen prices going up almost 30 to 40% within next past couple of months.
Yes, absolutely. That's something that people don't realize, that there are two forces that impact the housing price. One is government, namely taxes, as you all know, and the other is construction cost. You look at lumber, you look at labor. I think that the lumber cost probably will go down a little bit with the housing market slowing down a little bit in the US, but that will take at least a year. So at least we have another year of elevated lumber prices. And then all those construction workers, they will be in high demand because every country, Canada, the US, are engaged in a significant infrastructure boom. So those workers will be in high demand. So I don't see a significant easing in construction costs. I don't see them rising at the same rate as they're rising now, but they will remain elevated.
Yeah. So some of the, like in the commercial construction side, steel studs cost has gone almost 55% up for the last few months.
Absolutely, absolutely. That's
Right.
crazy. I totally, yes. People
So,
don't realize that. When
yeah.
people talk about the cost of housing, they have to also take into account the cost of building those houses.
Absolutely. So, Ornav, thank you so very much, Mr. Tal, for a very, very insightful presentation. And we look forward to your, hopefully, every quarter economic briefing for our members. And we are very proud to and honored to have you with us. And I would like to invite now our national convener, Ritesh Malik, to do the concluding remark. Ritesh, over to you.
Thank you so much, Satishji. Thank you, Mr. Turl. We know these are very uncertain and anxious times for most of us. But after listening to you for the past hour or so, we have every reason to be optimistic about the economy going forward. After all, as we slowly emerge from the worst phase of the pandemic, the constant worry about our personal finances and the economy in general persists. Thank you, Mr. Tull, for bringing a bit of good news to an otherwise desperate situation. We could do with some of it, and we can be confident that we learned today comes from a man who has his ears to the ground when it comes to economy and world markets. Friends, as we all know, Mr. Tull is responsible for analyzing economic developments and their implications for North American fixed income, equity, foreign exchange, and commodities markets. He also acts in an advisory capacity to bank officers on issues related to wealth management, household corporate credit, and risk. He has close to 20 years of experience in the private sector advising clients, industry leaders, corporate boards, trade associations, and governments on economic and financial issues. Sir, we are truly honored to have someone like you today with credibility on that CIF virtual platform today. Once again, on behalf of CIF and all the attendees today, heartfelt gratitude and thank you for sharing your wisdom and knowledge. Also, let me thank all our partners like ICICI Bank Canada, who are doing some great work in Canada-India corridor, and well-wishers in community and media for helping expand our reach. Thank you and good day. Stay well, stay safe, and stay healthy, both physically and financially. Good day.
Thank you. Good luck.
Thank you.
Thank
Thank
you.
you. Thank you.